as more and more people get interested in the cryptocurrency, more and more people want to know, how can I make money with my cryptocurrency? Well, you're in the right place. What's up everybody, I am Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. Cryptocurrency has been growing in popularity faster than ever, which is good for people who understand cryptocurrency, but for somebody who's just getting started with cryptocurrency and trying to understand it, it can be very overwhelming. First, you have to wrap your head around the idea of what cryptocurrency is, then you start learning about blockchain, then you start learning about altcoins, and then you start hearing about things like cryptocurrency staking, and then DeFi, decentralized finance. And it can become a lot of information very quickly, which can scare people and kind of push people away from trying to do anything because it's just a whole bunch of information. It's information overload. Cryptocurrency is a very unique asset class where there are multiple ways to make money off of the same currency, which is why in this video, I want to go over 5 different ways that you can make money with cryptocurrency. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below. And if you haven't already, be sure to join our free Discord community called the Guac Talk community, because as we all know, extra guac is truly a symbol of extra wealth, and in this community you can chat with other minority mindset thinkers and you can talk about the stock market, the real estate market, and of course the cryptocurrency market and everything else related to building wealth. This community is completely free, so if you're looking for a way to network with other minority mindset thinkers, I'll put the link to our free Discord server in the description below. So here's the agenda for today. I'm going to talk about 1, buying and holding cryptocurrency. I'm going to talk about how you can make money from the new age of saving cryptocurrency and how you can earn interest on that. I'm going to talk about how you can make money from DeFi. I'm going to talk about how you can make money from staking. If you've heard of these terms before and they made no sense, I'm going to try to break it down so it makes sense after this video. And then I'm going to talk about some of the tax loopholes that you can use in cryptocurrency. And you definitely want to pay attention to this because these might be going away. So make sure you watch this video until the end. And before we jump into this, I do have to give you a little bit of a disclaimer, because investing has risks and cryptocurrency has even more risks than that because it's a volatile asset class. So make sure you do your own research and never blindly listen to a random guy on YouTube. So let's start by talking about number 1, holding cryptocurrency. HODL is a term that a lot of people use in the cryptocurrency space. Started off as a typo of the word hold, but the whole idea here is you want to buy and hold cryptocurrencies for the long term. This concept is the most relatable because you have the same thing in the stock market where you want to buy a share of your favorite company, and then if this company grows, your share is going to be worth more, and then you'll be able to sell it for a much higher price later on, assuming that this company becomes more valuable. It's the same thing here in cryptocurrency, except you do have some differences. The goal of buying and holding cryptocurrency is, for one, obviously that your cryptocurrency becomes more valuable and that your cryptocurrency becomes more widely used. That way now either you can sell your cryptocurrency back to dollars and now you have way more dollars than you did before, or it's more widely used so now you can use this cryptocurrency to make transactions with. This is where you're going to have to do a little bit of research and understand what your goals are, because cryptocurrency started as the idea of just being this digital currency, but it's grown way past that. Bitcoin started with the idea of being a decentralized worldwide digital currency, which means it's a money that can cross borders, and 1 Bitcoin in America is the same as 1 Bitcoin in Japan, and it's the same as 1 Bitcoin in India. So now you can transfer money across the world. You don't got to worry about conversion rates, and it's very easy to pay people because it's all digital. Well, now cryptocurrency has really evolved way past just a currency because it's become a whole technology of its own. This is called blockchain. You might have heard of or seen the hype behind NFTs, non-fungible tokens. Well, an NFT is essentially digital art. You can memorialize something on the internet and then sell it. Now, whether you love the idea or hate the idea, that's not what I'm talking about. What an NFT is, it is this digital art, but it's built on top of the Ethereum blockchain. So now when you're investing in Ethereum, you're not just investing in a currency, you're investing in the blockchain. You're investing in the technology behind it. So now when more NFTs are built, or when more things are built on top of the Ethereum blockchain, this essentially pulls Ethereum out of the network, and now you still own a piece of the Ethereum. So as more and more systems and technologies are built on top of the Ethereum blockchain, these essentially pull some of the Ethereum out of the network, which limit the supply of Ethereum, which would in turn, in theory, make Ethereum more valuable as long as it maintains its demand. So when you're trying to find a cryptocurrency to buy or invest in, the 2 things that you have to pay attention to are the uses of that cryptocurrency and then the network. And let's talk a little bit deeper about both of these things. The uses are what the cryptocurrency allow you to do. Like Ethereum allows you to build NFTs on top of it. And Ethereum also allows you to build decentralized exchanges. I'm going to talk a little bit more about that and what that is when I get into DeFi's. But the whole idea behind Ethereum is it is a base technology which allows you to build more things on top of that. You can compare that to something like Bitcoin, where the use was for it to be a digital currency that you can use to pay people with. This is why you have so many different cryptocurrencies, because a lot of these cryptocurrencies work to excel at one thing a little bit better. For example, to send Bitcoin or to pay somebody with Bitcoin, it's expensive, it can take a long time, and there's a limited number of transactions that you can do in 1 minute or in 1 hour with Bitcoin. That's why certain cryptocurrencies are working to allow you to make transactions faster and easier and cheaper. And with Ethereum, it can be expensive to transfer Ethereum, and they can use a lot of gas in order to do that, versus you can use other cryptocurrencies which allow you to build certain technologies a little bit cheaper and a little bit easier. And then on the flip side, you want to look at the network. The network is really just the amount of people that are using the cryptocurrency. For example, if I own Bitcoin and I start to tell you and everybody else to start buying Bitcoin, this in turn benefits me, because if everybody else starts to buy Bitcoin, well, now there's going to be more buyers of Bitcoin, and that's going to make the valuation of Bitcoin more, because now there's more people buying. There's more demand of Bitcoin, while there's still a limited supply of cryptocurrencies like Bitcoin. That's one of the reasons why a lot of people have been adopting and moving towards cryptocurrencies, because the whole idea behind cryptocurrency is it is decentralized as opposed to our dollars, which are centralized. See, our dollars are controlled by the United States government and the Federal Reserve Bank, which can control and increase or decrease our monetary supply. And so what these central authorities and the central bank does can affect how much money that I have in my wallet. Although my bank account balance might not change, the amount of buying power that my $1,000 has will change. Like if you look back over the last few decades, the price of Coca-Cola, the drink, has gone up 20x. Now, the value that you're getting from your Coca-Cola has not gone up 20x. It's just that the value of your dollar has gone down significantly, and so now you need more dollars to buy that same can of Coke. And so the whole idea here behind cryptocurrency is you are able to limit the supply of cryptocurrency, which allows you to limit the manipulation of your money, in this case cryptocurrency, by somebody else. Plus, it's decentralized, meaning it's not controlled by one central agency or one central government. Like the Federal Reserve Bank does not control cryptocurrency. Just like that, the United States government does not control your cryptocurrency or your Bitcoin. Bitcoin, for example, is controlled by its users. So you have computers and networks around the world which control Bitcoin, so it's not controlled by one agency, which makes it less prone to this type of manipulation. So the first way that you can make money with cryptocurrency is just by buying and holding. Now, just like you have with the stock market and the real estate market, you have investors and then you have traders. Traders can make more money in the short term, but it comes with more risk. The more proven route to succeeding, whether it's the stock market, the real estate market, or in this case, even the cryptocurrency market, is by buying and holding for the long term. That can be a little bit harder to do, especially in cryptocurrency compared to the stock market, because the cryptocurrency market is way more volatile than the stock market. You see way more big swings up and down, which can get people excited and greedy and want to buy in when things are going up, because you have the fear of missing out, FOMO, and then when things start coming down, you can get scared and panic and sell, which can lead to crashes. I mean, it is possible that we could see another 2001 style .com type crash in the cryptocurrency market, but you have to understand that there's more value behind cryptocurrency than just a digital number. I mean, it is a real technology which will probably, in my opinion, be around for the future. And so you have to understand that if you are investing in cryptocurrency, you are going to see wild swings up and down. You do not want to be following the hype. You do not want to be chasing, but you have to be smart and understand what your goals are. Just like with the stock market, your goal is to buy low and sell high. So if you do see a crash in the cryptocurrency market, that could be a great time for you to come in and invest and buy in the cryptocurrencies that you believe in. Or if you don't want to be super involved, but you want to have some exposure to cryptocurrency, you can just dollar cost average your way into some cryptocurrencies. So you can find some cryptocurrencies that you like and find a platform which will allow you to create repeating buys, whether it's daily, weekly, monthly, whatever you want to do, and you can just dollar cost average your way in. That way you can get some exposure to cryptocurrency. Just remember, again, you are going to see a lot in volatility. It's not going to be uncommon for you to see days or weeks where you see 30% rises, and then the next week you see 30% crashes. This happens in the cryptocurrency market, so you have to be aware and you have to be smart, and you don't want to be buying and selling on emotion. You want to be educated and understand what the uses are. Yes, you can see a massive cryptocurrency crash, but you got to understand what your goals are, and you got to understand what it is that you're buying, because if you actually believe in the technology and if you believe in the usage of this cryptocurrency in the future, then those crashes are an opportunity for you to buy more. If you don't believe in cryptocurrency and if you think that people are not going to be moving towards this type of technology, well then don't buy cryptocurrency. The second way that you can make money in your cryptocurrency allows you to earn money without having to sell your cryptocurrency, because now you're going to earn interest on your cryptocurrency, but kind of like putting your cryptocurrency into a savings account. Now I'll put it in quotes because it's not technically a savings account. These are not banks that you're putting your money in, but that's the easiest way for me to explain what it is, but that's not actually what it is. So let me explain. There used to be a time where saving your money was the smart thing to do, because if you took your money, your cash, and you put it in your savings account, your bank would pay you somewhere between 8 to 10% a year on your savings. It was risk-free, and the bank would then turn around and they would lend your money out, but they would pay you 8 to 10% a year on your savings, which meant that your savings would actually grow. Nowadays, your bank's savings account pays you nothing, or at least next to nothing. And so if you put $100,000 in the bank, after a year, you might get a few pennies. Well, technically I might get a few dollars, but you get the idea. In cryptocurrency, there are centralized exchanges which allow you to kind of save your money. They park your money into these accounts, and then they will lend your money out, and in exchange, you will get interest. But the interesting thing is you can pull your money out, you can pull your cryptocurrency out whenever you want. So let's assume that you go out and you buy Bitcoin or Ethereum. What you don't want to do is just keep your Bitcoin or Ethereum on the exchange that you bought it on. So let's assume you bought it on Coinbase. You don't want to just keep your Bitcoin and Ethereum on Coinbase because then it's prone to potentially being hacked or stolen. So you want to put your money into a wallet. One thing that you can do is you can put your money, your cryptocurrency, on a cold wallet. A cold wallet is a USB drive, so you're going to take your cryptocurrency that's on the internet, and then you're going to take it off the internet and put it in a USB drive. Another thing that you can do is you can put it into a hot wallet. A hot wallet is a digital wallet, and so now your money is safe in this digital hot wallet, and it has a whole bunch of protections around it which make it hard for somebody to come in and hack it and take your money away. The third option is you can put your money into one of these type of accounts where now your account is going to earn you interest on your cryptocurrency. So if you have some Bitcoin or Ethereum, you can put your money in one of these exchanges, and then these exchanges will then work to lend out your cryptocurrency, and in return they're going to pay you interest for keeping your Bitcoin or Ethereum on one of these exchanges. Now, the good part is you can pull your money out whenever you want. The interest rate that you get on your cryptocurrency is going to depend on which exchange that you go through, because some exchanges are going to lend their money out, their cryptocurrency out, to more risky borrowers, and other exchanges are going to lend their cryptocurrency out to more stable and proven borrowers. What you'll see is that a lot of times your interest rates on these accounts, I'm not allowed to call them bank accounts because that'll get me into legal trouble, but your interest rates on these accounts will pay you much higher interest rates than the interest rates you get at your traditional bank account where you just keep your cash. And at this point you might be thinking, wow, I wish there was a safer way for me to earn these type of interest rates on my money where I didn't have to worry about the volatility of Bitcoin or Ethereum, because you see a lot of ups and downs in these type of cryptocurrencies. If only there was a way for me to earn this higher interest rate on a safer, kind of more stable cryptocurrency. Well, there is, thanks to something called stable coins, and stable coins are a kind of cryptocurrency which are tied to the value of a fiat currency, in this case our dollars. Now, without getting overly complicated, you have certain stable coins which are pegged to the value of the dollar, which means that they own or they hold on to US dollars based on how many people buy their stable coin. So in theory, if somebody goes out and buys $100 worth of a stable coin, this stable coin will then go out and gather another 100 US dollars. That way the stable coin's price don't change. There are other stable coins which don't hold on to US dollars. Instead, they're algorithmically pegged to the value of the US dollar. And there are other stable coins which hold on to cryptocurrency which try to mimic the value of the dollar. So if the dollar goes up or down, they'll sell or buy other cryptocurrencies to make up for that value. So now what you can do is you can go to one of these financial service accounts and buy up a stable coin like Tether, USDT, or USDC, which is a stable coin created by Coinbase, and then you have USDG, which is a stable coin created by Gemini. So these companies create these stable coins, you can convert your dollars to these stable coins, and then these accounts will pay you interest on these stable coins. And the interesting thing is, at the time I'm recording this video, you can earn between 7 and 8% a year. And the interesting thing is, at the time I'm recording this video, you can earn more than 8% a year in interest on your stable coins, and you can sell your stable coins and convert them back to dollars essentially whenever you want. So to put that in perspective, let's say you have $10,000. If you put this in the bank, you might get 0.01% a year in interest. This is what a lot of banks are paying out right now, which means after 1 year, you will earn a whole $1. Nice. Now, if you take these $10,000 and you move it to a stable coin, you will be able to buy 10,000 stable coins that are valued at $1 each. Now, the stable coins might pay out, let's just say 8% a year in interest, which is not uncommon. Then you will be able to earn $800 in 1 year on these stable coins, and then you have the option to pull out the 10,000 or the 10,800 whenever you want. Remember, these stable coins are pegged by the value of $1, so they don't really change. They stay at $1, and you can buy one stable coin with $1. Now, at this point, if you're like me, you're probably wondering, okay, Jasprit, that sounds cool, but what are the risks? Because that's exactly what I was wondering before I moved a big chunk of my savings here to earn this interest on my stable coins. The first risk is that these financial service institutions are not FDIC insured because they're not banks. And so if you remember back before the Great Depression, there was no FDIC insurance. And so when there was a run on the banks, you saw some banks collapse and people were not able to access their savings. That's why when you're looking for a company to pay you interest, you want to make sure that you have a reputable company that's well funded. That way, in case things go wrong, they have reserves to help pay you out. Second, you want to make sure that your cryptocurrency, in this case, is safe on this financial service institution's platform. So what you want to make sure is that this financial service institution that you're using is taking your cryptocurrency and they're putting it in cold storage. That means you give them your cryptocurrency, that way you can earn interest on it, and while it's sitting there, they will take it and put it on USB drives, that way your cryptocurrency is safe, and that they insure your cryptocurrency, that way it is actually protected, and they have the right firewalls to make sure that your cryptocurrency is protected and safe. And third, there's a chance that your cryptocurrency or the stable coin that you're buying into goes bust. For example, USDT is a stable coin owned by Tether, USDC is a stable coin owned by Coinbase, and then GUSD is a stable coin owned and created by Gemini. All three of these stablecoins are created by three different companies, and the risk here is what happens if Coinbase goes bankrupt? If that happens, then you could lose the value of your stablecoin and it might no longer be pegged to the value of $1. I mean, it could create a lot of problems. The way you can kind of work around that is one, research which stablecoins you're investing your money into, see if they're regulated, see if they're backed, see what they're doing to protect their stablecoins, and second, you can also diversify across different stablecoins. So again, just do your research. So is earning this type of interest on your stablecoins completely risk-free? No, it's not, but you can mitigate a lot of your risk by learning and by not getting greedy, because you're going to have some exchanges that are going to offer you way higher returns, and they're going out making riskier loans, and then they're going out and they're cutting corners on your protection. So yeah, you might get a better return today, but there's a higher chance that you could lose your money. Again, it just comes down to doing your own research and seeing what's right for you. I have moved a big chunk of my savings into stablecoins, which are paying me this 8% a year in interest, and I'm waiting to use this money to invest it into other investments or real estate or somewhere where I really want to park my money, but in the meantime, I'm putting it here, and I'm using a platform called BlockFi, who is also a sponsor for Minority Mindset. The way BlockFi works is exactly what I just talked about. You can buy stable coins, or you can buy Bitcoin, or you can buy Ethereum, or a number of other cryptocurrencies, and then you can earn interest on your cryptocurrencies directly through BlockFi. The reason why I like BlockFi is because they're lending the cryptocurrency out to top-tier institutions, so it's a little bit safer in that regard. You're not going to get as high of an interest rate with BlockFi as you would on some other platforms, but your money is a little bit safer because now these institutions are backed by a lot of dollars. Plus, if you're interested in dollar cost averaging something like Bitcoin or Ethereum, you can just set up a repeating purchase on BlockFi, and then your Bitcoin or Ethereum will be automatically bought and it'll automatically start earning you interest. So you can set up a dollar cost average system where now every single day you're buying a little bit of Bitcoin or Ethereum, and as soon as you buy it, it'll start earning you interest. So if you want to learn more and see what kind of interest rates you can get on your cryptocurrency or your stable coins, I'll put the link to where you can do that with our sponsor BlockFi in the description below. Minority Mindset is a paid partner with BlockFi, so if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more and see how much interest that you can earn, I'll put the link to where you can do that in the description below. The third way that you can make money on your cryptocurrency right now is through a concept called DeFi. Now, DeFi gets a little bit more advanced. It stands for decentralized finance, and I'm going to try to break it down in the simplest way possible. So if we start at a very high level, DeFi is really just the entire financial services industry without centralized organizations. With DeFi, everything is done peer-to-peer. So let's assume that you want to get a ride to the airport. Instead of going to Uber to find a driver, you can just connect directly with the driver. Or if you want to get insurance, instead of getting insurance through an insurance agency, you can go directly to people who will give you insurance. Now, this concept of decentralization is very popular in cryptocurrency because people like the idea of being anonymous. They don't want to be monitored or controlled by the government, and so they like the idea of their cryptocurrency being decentralized. So if you go onto Coinbase, for example, and you convert your Bitcoin to Ethereum, or if you buy Bitcoin, you're doing this on a centralized platform because this is controlled and run by Coinbase. Coinbase is one central company which runs the platform. So now you go onto Coinbase and you make a transaction, Coinbase knows what you did, and they can even report this to the SEC or the government if they wanted to, or if the government forced them to. So Coinbase is an example of a centralized exchange, but you also have decentralized exchanges which are built on top of the Ethereum platform. These decentralized exchanges work kind of like Coinbase, except now everything is anonymous. It's not run by one organization, it's run by a whole bunch of different computers all around the world, and so everything is anonymous. Now you can go to these decentralized exchanges. One popular example is an exchange called Uniswap. You can go here and now you can exchange one cryptocurrency for the other. So you transfer your cryptocurrency here, you transfer it to the other, and it's all completely anonymous. So that's what DeFi is. DeFi is the financial industry that is decentralized, not controlled by a single entity. How do you make money through DeFi? Well, you can go to certain DeFi platforms and lock up your cryptocurrency there, and then once your cryptocurrency is locked up, this DeFi platform will then use this cryptocurrency. Maybe they'll lend it out, or they use it for liquidity. There's a lot of different things that they can use it for, but in exchange, they will pay you with interest. A couple popular examples of these type of DeFi platforms are Compound and Aave, AAVE. Again, locking your cryptocurrency up in a DeFi platform has its own fair share of risks, and if you're just starting off, this might be a little bit too advanced, but this is what cryptocurrency enthusiasts love, because cryptocurrency was built on the idea of being decentralized, and a lot of it is having to do with being anonymous. So cryptocurrency enthusiasts love the whole DeFi industry, but if you're just getting started, this might be a little bit overwhelming. The fourth way that you can make money with your cryptocurrency is by staking your cryptocurrency. You might have heard of a concept called Bitcoin mining, where people set up these advanced computers that solve math problems, and when you do that correctly, you get rewarded with more Bitcoin because now you are helping to produce more Bitcoin. Well, for other cryptocurrencies like Ethereum and Cardano and Polkadot, you don't have mining, instead you have staking. And the way it works is now you are going to lock up your cryptocurrency, and then your cryptocurrency will be used to help maintain that network, and in return you will get paid with more of that cryptocurrency. The tricky thing here is you don't always know how long your cryptocurrency is going to be locked up for, and you don't always know what kind of interest that you're going to get. But if you're one of those people that owns a cryptocurrency and you know you want to own it for a long time, you could either just keep it there in your wallet, or you can stake it and then earn some interest on it because you're going to be holding on to it anyways. Initially, if you wanted to stake a cryptocurrency, it was pretty advanced and pretty technical because you had to have a designated computer set up to do that. Now you have exchanges and wallets that do it for you, which make it a whole lot easier. A couple examples of exchanges that allow you to stake your cryptocurrency are Kraken and Binance, and now even Coinbase is getting on it. And the fifth way that you can make money through cryptocurrency are through tax loopholes. And before we dive into this, I do gotta let you know that although I am a licensed attorney, I am not your attorney. So if you have specific tax questions or legal questions, you need to talk to a professional in your area. So now, if you go onto the stock market right now, and let's assume that you bought a stock and you paid $10,000 for it, and then the value of the stock drops down all the way to $5,000, you were at a loss of $5,000, but you don't actually realize that loss until you sell. But now let's assume also, for the sake of this example, that you also have another investment that you made where you had already sold it and you have a profit of $20,000. Well, now you're going to have to pay taxes on this $20,000 worth of profit. But what you could do is, if you sold this, then you're going to have a loss of $5,000. And then you could tell the IRS, hey, I made $20,000 here, but I lost $5,000 here. So technically, I only have made $15,000 net. So now you're only going to pay taxes on $15,000 because you made 20, but you lost 5. But now let's dive a little bit deeper, because what if this is an investment that you believe in and that you want to own forever? What if you just sold the stock, you took this $5,000 loss, you only paid taxes on $15,000, and then immediately after you made this sale, you buy the stock right back up? Now you got the best of both worlds. You get this tax loss, that way you get to pay less money in taxes, and then you still own the stock. So you really didn't lose anything. But the IRS says that you're not allowed to do that in the stock market due to something called the wash sale rule, which says that if you're going to sell your stock at a loss to get these type of tax benefits, well, then you're not allowed to buy the stock back up for at least 30 days. So that's how it works in the stock market, but that's not how it works in the cryptocurrency market. Because right now, there's a little loophole which allows you to do this exact same thing in the cryptocurrency market, but you don't got to worry about the wash sale rule. So at the time of me recording this video, this is legal in the cryptocurrency market. You can own Bitcoin and you can see a loss in your Bitcoin or Ethereum, and then you can sell it, buy it right back up, and if you have a loss, you can use that loss to offset some of your other gains and maybe even some of your income. There are certain ways for you to sell your short-term losses, and now if you have these short-term losses, you can offset these losses against your own income, and then you can buy those losses right back up. So if you're losing money in Bitcoin or Ethereum, you can just sell it, take these losses, deduct it against your taxes, and then buy right back up. So you own the asset, you got the tax deduction, and you got the best of both worlds. Now the interesting thing here is it looks like the IRS might be cracking down on this soon. CNBC recently put out an article that says that it looks like the IRS is trying to crack down on this loophole. But as of now, it's still around. So you can talk to your accountant and see how you could potentially use this to pay less money in taxes legally. If you like what you saw so far, then you're gonna love this. When you're getting started off as an investor, there's two different things that you can invest. You can invest your money, that's the most obvious thing, or you can invest your time through your labor. The thing that differentiates wealthy people and financially educated people from everybody else is when wealthy people and financially educated people make money, they reinvest this money because they understand that your income, whether it's from your job or your business, it's not going to make you rich. Your investments are what will make you wealthy and rich. And so what wealthy people and financially educated people are doing is they're making money and now they're investing it. That way their money's working hard to earn them more money. Now this comes with its own fair share of pros and cons, because the good news is you can start investing your money with as little as $100. Today I'm going to be talking about how you can invest your first $1,000. But the bad news is if you just have $1,000 to your name and you invest this money into a passive investment, you are not going to become rich overnight. But $1,000 is a very good start. And now if you blend this money with your time through your labor, now you can grow your money even faster. Now before I get into how you can actually invest your $1,000, a couple housekeeping rules. First, if this is the only $1,000 you have to your name, you need to first build some savings. You need to have a savings cushion because life will happen and you don't want to go into credit card debt when your car breaks down. So you want to make sure you have a little bit of savings before you start investing your money. Second, if you have high interest debt, if you have credit card debt, other things like that, where you're paying 10, 12, 15, 25% a year in interest on this debt, pay this off first. If you don't, then it'll almost be kind of like walking around with a 1,000-pound weight chained to your leg, because now you're trying to go forward, you're trying to build wealth, but you got this weight chained to you that's holding you back. And so if you have this high interest debt, pay that down first, because this debt is skinning you alive. If you have low interest debt, we're talking about student loans, mortgages, then yeah, you can kind of work around that. Now this depends on your risk tolerance. I'm not saying that's what you should do, but if you have high interest debt, then you definitely want to be paying down your high interest debt before you start investing your money. Now that we got that out of the way, when it comes time to actually investing your $1,000, there's a couple of different ways that you're going to invest this money. You can invest this money the active way. This is now when you're investing your money and your time through labor, and the passive way where you're only investing your money. Starting with the active way to invest your money, there are a ton of businesses out there that are very successful today that started with less than $1,000. Like Minority Mindset started off with less than $1,000, and now we are a full financial media company. The whole idea with actively investing your money is you are going to invest this $1,000, plus you're also going to invest your own time. So this might be your own brain power, your own thoughts, your own creativity, your own labor, whatever it is to help grow this money that you're investing into your company. And so here, you're essentially going to be starting your own business, because you're going to take this $1,000 and you're going to use your own knowledge and your own labor to grow this money. Maybe you're going to go out and buy something and sell it for a higher price. Maybe you're going to start flipping something. Maybe you're going to start an e-commerce store. Maybe you're going to start a blog online. You can start something with this $1,000 with your own effort to grow this $1,000 into something a whole lot bigger. Now, before I go too deep into the different things that you can do right now to grow your money, the thing that I want you to understand here is you can make way more money, actively invest your money, than you would by passively investing your money. Now, there is more risk here because you're essentially starting your own business, but you have the opportunity to make a lot of money because there's no limit to what kind of returns you can see when you start your own business. Now, when you do start your own business, there's two things that you have to understand. Every business works this way. I don't care what type of company, what kind of business you want to start. Every single business works this way. So businesses all have two components. Component one is the product, and component two is the customers. If you have a product and you have customers that are buying your product, you have the things that you need in order to build a successful business. Every single business needs these two components in order to be successful. Now, your product can be anything. Your product could be something you find off of Alibaba or AliExpress in China. Your product can be something that you create. Your product could be your services. Your product could be your labor if you like doing things like landscaping or painting. Your product could be your mind if you're an accountant or if you're a consultant. So your product can be a product, a physical product, or a service. Customers are now the people that are going to give you money for the value that you provide. Now, thanks to the internet, finding customers is much more accessible. Not necessarily easy, but much more accessible than before, because back in the day, before we had the internet, if you had a product and you wanted customers, the most common way that you would find customers is you'd have to rent a very expensive office space or a storefront. And if you wanted to get a storefront in a prime time location, it's going to cost you a lot of money. And so your customers were kind of reserved to people within 20 or 25 miles of your office. Nowadays, you can target customers from all around the globe thanks to social media, thanks to the internet. Now, the downfall with that is you're going to be competing against everybody in the world. So you have to be a little bit more clever here with digital marketing. But if you can understand how digital marketing works, now you have the whole world on your fingertips as customers, and you just need to have the right product to market to your customers. This is where the more creative you are, the more money you can make. The first real business that I ever started was an event planning business. I started working at weddings and I got to know a lot of the DJs. And because I knew all these DJs and I knew a lot of people, I got into this kind of party hosting business. I was hosting college parties. And so what I would do is I would go to venues, clubs, restaurants, and I would talk to these venues about hosting parties. So I would talk to the venue and say, hey, can I rent out your club or your restaurant for a night? And I would try to do that where I wouldn't have to pay the club owner, the venue owner, anything. Now, I would rent out the space and then I would spend some money. I started off with probably like $200 or $300. So it wasn't really a lot of money, but I would spend a little bit of money trying to get the word out about this event. And now I would work with DJs who I knew, so they wouldn't charge me anything. They would take a percentage of revenue would make at the door because I would charge a cover fee, $10 or $20 for you to come into the event. And the DJ would take a percentage of that. And the restaurant or the bar or the club, they would take whatever money they made off of drinks. Now, I wasn't into partying. I don't drink. I just got into this business because it was the only thing that I knew. And so that's how I got started. And I didn't need a lot of money because I was creative, I knew the right people, and I was able to talk to people. So I got customers by spending a little bit of money in marketing, getting the word out there. It's even cheaper now because you can use social media, but I did kind of more traditional marketing then with flyers and things like that. My product was this event, and so I'd connect the two, and that's how I started making some money. If you're good with your hands and you don't mind getting dirty, another few products that you could do are potentially auto detailing or landscaping work or painting work. And so now this is your product. You know that you can detail cars really nicely. You know that you can do landscaping work really nicely. You know that you can paint homes really nicely. You got to get customers who are going to pay you to do this work. And so what do? Now you can do flyers. You can do Facebook advertising. You can do Instagram marketing. And now you want to find people in your area who have money, who have these needs. They want to get their car detailed or they want to renovate their homes. And so you want to connect with these people, use your money now either to get some tools or to get that marketing. That way you can get in front of these people and you can let them know, hey, I'm starting this new company where I can do auto detailing, landscaping, painting, whatever. And now you can get the customers in order to do that. And this is again where you can be creative. Maybe you give this customer a 50% off discount if they refer you a friend. Or maybe you even give this customer a free auto detail if they're willing to put a flyer up on the front of their lawn, or if they're willing to tell their friends about it. So, you really just got to be creative here because you want to build a customer base that you're just going to keep coming back again and again and again, and you want to be able to find more customers. That way you can increase your product, because at the end of the day, if you are auto detailing or landscaping and it's just you, you're not going to be able to scale. However, if you can bring on more people with you, this is difficult. It's not easy to do, but if you can bring on more people, Now you can scale if you can work on growing this. So if you can grow this, you'll be able to grow this. If you're not the type of person who wants to get their hands dirty and do all this physical labor, then you can come on the internet. Now you have a whole list of products that you can have. You can start an e-commerce store. And so now you can buy products from China, or you can create your own product and sell them to customers on Amazon or your own e-commerce site. You can start a blog. You can do affiliate marketing. You can start a podcast. You can start a YouTube channel. And now your goal is to build an audience. Even if you have an e-commerce store, you want to have a large social presence. That way you can have people constantly coming to your store to buy your products. The stores that make the most money on the internet are not just the random kind of stores that have no internet presence, that don't have a blog, that don't have an Instagram page. It's the pages, it's the companies that have large social presences, that have large blog presences, because now people are already watching your content. And now when you go onto your Instagram page with 100,000 followers and you say, hey, we're having a Black Friday sale, or hey, we're having a 20% off sale this weekend only, you have a lot of people that are seeing your posts, because if you have 100,000 followers who are interested in your product and they see that you're having a sale, now you're automatically showing your product to the right customers, right? So the internet is kind of like the new age digital real estate, because if you own a piece of this digital real estate, because if you have a large social presence, you have a large blog presence, now people are already seeing your content. And now what do? You just market them your product. If you have a blog and you don't have your own product, well, now you can use advertising as your product. You can become an affiliate marketer for other companies in your niche. So if you have a fitness blog, you can partner with other protein supplements. Now, this isn't a product that you created, but you can partner with another protein company and you can market them on your product. And if anybody buys this product from your website, you get paid. So there's an unlimited way to make money if you have this kind of digital real estate on the internet. You just have to have the customers. Who are the customers? Well, this can be people who follow you on your website or your social media. You just want to make sure that you have the right products for these customers. Even for us, I'll show you the way Minority Mindset works right now. The way we work is we try to put out valuable education, valuable content that's fun to watch, and then people watch our content, and then we market products that we think are good. So this part is hard. If you are a brand and you want to work with us, it is very difficult to work with us. We reject like 99% of the brands that want to work with us, but the brands that I love, that I personally would use myself, I will market these products to our audience because I support these brands. I would use these brands myself and I believe in them. That's one of the reasons why I think that we have been able to grow so fast, is because people realize that we're not sitting here promoting crap all day. And so like in this video, I talked about Fundrise. Fundrise is one of our products, one of our sponsors that we work with. When people use Fundrise through us, we get paid, right? I don't try to kind of dance around that topic. I make it very clear. We get paid when you use one of our affiliate partners, but that's the way that we work. We don't create Fundrise, we work with them. But if somebody watches our videos, they like our products, they like what we say, then you can support us by using our affiliate partners. A few other ways that we make money is one, through our newsletters. We have a daily financial newsletter, and these newsletters break down what's going on in the finance and business world. And in these newsletters, we have sponsors. We have a blog, which we drive revenue through advertising and affiliate partnerships. And we also have a few classes that we sell. And so these are the different products that we have. And now we have customers. This is our audience, people who are interested in learning more about financial education, people who want to be financially educated, and we connect customers with the right products. Now, the thing that makes us different from a lot of kind of your traditional brands is we don't try to shove products down customers' throats. We're not coming here on YouTube selling. 80 or 85% of our content has no products mentioned at all. This is what makes us different. Most of our content has no product pitches at all. Most of our content is completely free. But if you want to get the extra little bit, that's our classes. Or if you want to get the extra little bit on your kind of products, that's where we occasionally market our products. I started Minority Mindset on YouTube, making videos with my cell phone in front of a white wall. It cost me a few $100s. And so if you have $1,000, you can start up your own business idea. You just got to understand the product and the customer. You got to know what your product is, and you got to know who this customer is. And now you got to use your money smartly and creatively to get customers to buy a product. That's the essence of now actively investing your money. Once you kind of get an idea of what you're doing, the next thing you got to do with this money is you got to make sure that you're learning. Okay, because the thing that can accelerate your growth, the thing that can help you go from 0 to 1,000 to 10,000 to 100,000 to 1,000,000 is if you understand how to grow your business, if you know how to grow this active investment. And one of the easiest ways to do that is just by learning from other people. That could mean you're reading books. That could be watching YouTube videos. That could mean buying classes. I have bought a ton of online courses from people that are doing things, because when you learn from them, now you can accelerate your growth because you're learning from other people that understand digital marketing. You're learning from people that understand email marketing. You're learning from people that understand Facebook advertising. And so yes, it does make sense to invest in some of these courses when you have a need for these courses and if you understand the real kind of purpose of this course. Because the thing where kind of people make mistakes in this online course space is to start taking these online courses hoping they're going to get rich quick, but they have no idea what they're going to use this course for. And so if you have this business right here, or if you have this kind of thing that you're working on, and now you have a specific thing that you want to learn, like let's say you want to learn how to grow your blog quickly. Now, if you take a course on how to grow your blog, that information you can plug in right here, as opposed to just taking a random course and thinking that you're going to get rich quick. When I started getting involved in real estate, I went to a real estate seminar where somebody pitched a course on real estate wholesaling. And this course was $3,500, which was a lot of money for me back then. And I decided to make that investment. I bought the $3,500 course, and I didn't make any money for the first 4 months. But after about 4 months, I started closing deals in the real estate wholesaling space. And real estate wholesaling, your deals, once you close them, they can be kind of big. Like my first deal was $10,000. And so, yeah, I made my money back. It took me a lot of time, took me a lot of effort. But then a few months after I started making money, I stopped doing real estate wholesaling. It wasn't me. And so another thing that you have to understand is you have to be adaptable. I went through kind of business after business after business before I started to really realize what my passion was, what I liked doing, and where my talents were. And so this is one of those things where you have to be just kind of adaptable, because we don't learn entrepreneurship. We don't learn how to grow our money in school. And so when you're learning, you have to be willing to adapt. You have to be willing to grow. You have to be willing to make mistakes, and you have to be willing to learn. And one of the ways you're going to learn is when you realize that something is not for you, then you have to be able to switch. Now, the good thing here is even if you kind of stop a bunch of different things that you're working on, you're going to learn something from everything that you do. I mean, even if you start an e-commerce store and then you start a landscaping business and then you realize that you want to start a podcast, you're going to learn something from your e-commerce store and your landscaping business that you can use in your podcast that other people don't know. And so you're going to learn things along the way, but you just got to make sure that you keep moving forward and you keep trying new things, because that's the only way you're going to learn and it's the only way you're going to grow. So if you only have $1,000 or so to invest and you don't have $1,000 every single month coming in to invest even more, then you got to work on growing your income. The way you can do that right now is by actively growing your money. This might mean starting your own business or starting your own side hustle. And the way to make that work is you got to understand products and customers. So you need to use your $1,000 to know what your product is going to be. Maybe you got to buy some products, and then you got to find customers. This might mean advertising. This might mean organic marketing, finding customers through your social media or through your blog. Once you can connect this, then you will be able to grow this active income. Now, once you start growing your active income, that's when you have to start growing number 2, your passive income. Your passive investments are what is going to make you wealthy without you having to physically work. So now, if you have this active money coming in, this might be through your job, this might be through your business or your side hustle like we just talked about. As soon as you start making this money, you got to start hammering this money here into your passive investments, because this is what's going to make you long-term wealth. And so what you see a lot of wealthy people do is either they're making money from the job or they're making money from the business, and now they're taking as much money as possible and they're putting that here into their passive investments. Now, there's a couple of different ways if you have $1,000, and this is $1,000 consistently coming in, because if you only have $1,000, then passively investing your money is not going to make you the greatest returns. But you can do that. I mean, I'll talk about what the type of returns you're going to see. But there's a couple of ways that you can kind of get these returns on your money through your passive investments. One of the easiest ways to do that is through an ETF. So this is through the stock market. The stock market is a place where you can go and invest in companies, stocks. And so when you invest in the Amazon stock or the Apple stock or the Chipotle stock or the Lululemon stock, you become one of the owners of these companies. And so an ETF now allows you to become an owner, not just of one company, but of a whole basket, a whole group of companies. Because if you want to be a passive investor, now you don't want to spend that time to constantly research companies, constantly read their earnings columns, constantly see how much money they're making, what they're doing. Because if a company starts to go down and all your money is in one company, now your whole investment goes down. With an ETF, this stands for Exchange Traded Fund. Now you're investing in a whole group of stocks. And there's a whole bunch of different kinds of ETFs out there. they can invest in ETFs that give you exposure to the top 500 companies in the stock market. A couple examples of that would be VOO or SPY SPY. Now, I'm not telling you what to invest in, just an example. But those two ETFs give you exposure to the S&P 500. That's the top 500 companies in the stock market. So if you just want to invest in the general stock market, those two ETFs will allow you to do that. You can invest in ETFs that give you exposure to tech companies. You can invest in ETFs that give you exposure to growth companies. You can invest in ETFs that give you exposure to dividend stocks. You can invest in ETFs that give you exposure to REITs or healthcare. So you have ETFs that give you exposure to really anything that you want. And so if there's an industry or a sector that you want to invest in, but you don't know what company to invest in, or you don't know how to do the research, then an ETF is a great way to go. And the easiest way to find these ETFs is literally just go to Google and search blank ETF. So if you want to search technology ETF, healthcare ETF, whatever it is, you can search these ETFs. Find this ETF, look at what companies they invest in. If you like those companies, then that could be an investment that you're investing in. Now, if you want to make this successful, the thing that makes passive investing the most successful for people is you have to consistently keep investing money into this ETF. That might be every 2 weeks, every time you get paid, or every month. So if you want to become a successful passive investor, especially through ETFs, this is something that you have to keep consistently investing your money in. The thing that I like about ETFs is you can invest in ETFs with as little as $100. So now anytime you get paid, you want to take a portion of your paycheck and you want this to automatically go into your stock brokerage account and have this money invested into your ETFs. That way every month your account is going to keep growing and hopefully your ETFs are going to keep growing as well. So now you keep putting more fuel into the fire and now you're just building this wealth on the side. If you do want to learn more about how to invest in ETFs passively, and do this in a way where now anytime you get paid, this is going to automatically go into your investment accounts. Our team has put together an amazing article on our website, theminoritymindset.com, that walks you through how to passively invest your money in the stock market. So if you want to learn more about that, I'll link that article for you in the description below. Now, I'm going to try to be respectful for your time because there's a lot of different ways that you can invest in stocks passively, and they all follow the exact same model as what I said for ETFs. So if you want to invest in dividend stocks or growth stocks or whatever, you can just do the exact same thing here where you automatically passively invest your money into these stocks every time you get paid. So I'm not going to go over every different type of investment in the stock market, but you can just kind of assume that it's the exact same thing as ETFs. The second way that you can passively invest your money is by investing your money into real estate. Now, the thing about real estate is you're not going to be able to go out with a $1,000 right now and go buy a property and have this passive investment where now you own this property and a tenant's living there, they're going to pay you rent. You're not going to be able to do that with $1,000. But what you can do is use something like our sponsor Fundrise, and now you can invest in crowdfunded real estate, where now you're getting exposure to a portfolio of real estate properties. And as these properties make money through rent, so do you. And as the value of these properties go up, you make money as well. Again, if you are interested in learning more about crowdfunding, I got the link to how you can do that in the description below. And another way that you can invest your money, this is not necessarily real estate, I mean, it could be, but is through peer-to-peer lending. So you see a lot of peer-to-peer lending for real estate deals where people go onto a website where they now borrow money from another person. That's why it's called peer-to-peer. Now, a person is not going to borrow $1,000 to go out and invest in real estate. They're going to need more money than that. But you could do peer-to-peer lending to invest your $1,000 by lending this money out to somebody else. Now, peer-to-peer lending has its own risks because you got to make sure that the person that you're investing into by lending your money into them is creditworthy, that they're going to pay you your money back. But it's another thing that you can look at, and it's kind of indirectly related to real estate, but it's another way that you can passively invest your money. Thank you for watching. If you enjoyed this video, here's the video on investing money that I think you'll love, and while you're at it, download our free guide on how to start generating passive income. And as always, keep hustling.
You have an income, so you can cover your cost of living, and then your excess savings, you can then risk if you want to, because you can always make it back over time via your investments, and you're not going to lose your house.